Good morning, everyone. My name is Tracy McKibben. I'm the chair of the Finance Committee of the New York Power Authority and the New York State Canal Corporation. I'd like to welcome first our committee members, Chairman John Canal, Dennis Traynor, Michael Balboni, Eugene Nicandri, and Anthony Pacenti. I'd also like to welcome the NYPA and Canal Corporation staff. I appreciate everyone's, agileness in joining us this morning under the circumstances. So hope everyone's safe and healthy. And with that, I'd like to state this meeting has been duly noticed as required by the Open Meetings Law, and I call this meeting to order. I think everyone's had a chance to review the agenda for today, and I'd like to ask if there are any amendments to the agenda.
Happy to move the agenda be approved.
Thank you. So moved. If I could get a second.
Second.
All in favor, say aye.
Aye. Aye.
Any opposed? Great. Motion carried, and the agenda is adopted. The next portion of this meeting will be held in executive session. I ask for a motion to conduct an executive session to discuss the financial and credit history of a particular corporation and matters regarding public safety and security pursuant to Section 105 of the Public Officers Law. If I could get a motion?
So moved.
Second.
Second. Moved and seconded. All in favor? Say aye.
Aye.
Any opposed? Great. We will move into executive session. Thank you. I'd like to ask for a motion to resume the meeting in open session.
So moved. So moved.
I can get a second.
Second.
All in favor, say aye.
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 Any opposed?
Aye.
Motion carries. Great. I'd like to state that no votes were taken during the executive session. We will move right into our special agenda. I'd like to invite Rob Piasek, our SVP and Chief Information Officer, to present the next 4 items on the agenda around our information technology plan. Rob?
Tracy, thank you very much. And by the way, good morning, everyone. I'd like to say it is so good to see everyone. I hope you all are safe, well, and this will be unusual distant. It's amazing to work that into our vernacular. To effectively use our time this morning in presenting the material, and since you have the presentations and the memos with the details, supporting detail, what I'd like to do is I'm going to provide an overview to set the context and then walk through each of the details of the 4, and then come back for questions. That way you can see the bigger picture and how they are interrelated, if that makes sense. So with that said, in terms of an overview, simply put, I'm here to seek the approval of a total capital expenditure of $78.7 million for 4 initiatives over 4 years. The first 2 are critical to sustaining NYPA's core digital technology, and the last 2 are really focused around implementing essential, and I'll repeat, essential capabilities for NYPA to be able to manage and protect our assets. Just to kind of set the tone there. Of the $78.7 million, 24.3 or 31% is included in the 2020 budget, which you all approved previously. The balance, the 69% or 54.4 million, will be spent according to the 4-year financial plan that was approved in January by the board. The funds associated with each of these initiatives will be covered, and included are the internal and external labor, software, and hardware. Now, to execute this work, we will seek, this is an important point, we will seek diverse range of suppliers using our procurement mechanisms that we have available to us today to strive to meet the minority and women business enterprise, or what we call MWBE in the acronym, and the service disabled veteran-owned businesses, or SVOB, goals. That's important here. We will also come back to the board at the appropriate time to seek approval and use the required process of the expense authorization procedures. And that's true for all 4 initiatives going forward. To take you through, as a reminder of the material that you've reviewed already, the first initiative is called the Core IT Infrastructure LEM program. And as you all know, LEM is a life expectancy modernization. This is a 4-year program. It totals $18.2 million, of which 4.2 is planned in the 2020 budget. Essentially, we are targeting the end of life and end of service life of tangible assets that are required for us to maintain our enterprise infrastructure. Examples are included, but I'll mention them: the network, the servers, the data center, mobile devices, our HVAC systems within our data centers to keep things cool, surveillance systems, etc. That's all included in that first SEER. The second SEER, number 2, it's called the Common Application LEM program. This is a 4-year capital program. It totals $18.9 million, of which $4.4 million was planned and is planned in the 2020 budget. The target is to upgrade and to patch the intangible assets that are required to maintain the enterprise software infrastructure that we have today. And again, that inclusive of that, it would be our operating systems, what we refer to as middleware, SAP, our database platforms, business applications, etc. The third program is cyber, or what we call cyber resilience. It is a 4-year capital program totaling $30.6 million, of which 7.1 is planned in 2020. This consists of really 4 sub-programs that are worked in combination to provide cyber critical capabilities that will help us to further protect our NIPA digital ecosystem from our threats and vulnerabilities. And it is part of, which we reviewed last board meeting, our cyber strategy, multi-year strategy. The fourth initiative is called the Data Management Program. It is a 2-year capital program, and that's probably my phone. Capital program totaling $10.8 million, of which 8.5 is planned in 2020. This really consists of 2 sub-programs as well to combine for the functional capabilities for NIPA to manage our enterprise at scale. And I use that expression purposely because we are amassing data, and as you recall in some of the SEER work that I requested last year, we're increasing our data volumes by 330%. It needs to be actively managed in terms of data privacy, data security, and overall data management. This program will help in the terms of the data governance, the ability to integrate that data or data integration, and to improve the quality. Not to mention to manage the PII and PHI aspects. And the second aspect is around the data analytics platform for us to be able to massage and analyze that data using machine learning, advanced analytics, and predictive analytics. So those were the 4 programs that make up the overall 78.7 over 4 years. I'm going to pause there for any questions.
Just explain what SEER is.
I'm sorry, the Capital Expenditure Authorization Request.
SEER.
Thank you, SEER.
Great. Rob, I guess the first question that I had is for you to help us understand, because I think what we had directionally, the trustees had approved previously was about 76, if you look at the total of the current request, it's $76.5 million. But today that you're coming to us asking for, I think the total ends up being about 24.2. Can you walk us through why, light of where we are currently with the crisis and our belief that we're only focusing on what's essential spend for NIPA as we, approach this as not business as usual, why these are critical spends, and confirm that they are ones that you want to do now, and why these are important investments for us to be making at this time. If you could just help me understand, sort of this focused for just 2020, this amount to gain.
Sure, and absolutely, Tracy. So the 24.3 is 31% of the overall ask over the 4 years. And we had assessed, looking at the infrastructure, the age of the infrastructure, how it becomes end of service life, and our ability with third party to be able to continue to support the infrastructure, hardware, software, plus the cyber capabilities as well, that we feel it's essential for the 24.3. And it's based on systems that do expire and software that does expire, and to give us sufficient lead time in order to get ahead of that, to perform the upgrades, the patches, to remediate systems before they become an issue under duress. So let me give an example. So we've spent $2 million through a preliminary approval in the cyberspace as an example. And thank God we did. Because within that expenditure, the $2 million, we had fortified our firewalls in the way we provide capacity, the way we configure it, to allow us the flexibility to allow people to use and access our platforms. We are in a very good shape today in supporting the situation that we've all confronted by exercising and applying that investment, the $2 million. That's just a portion. But then if you apply that across the enterprise around, again, the servers and the platforms, we have to have the ability, or need to have the ability, to be able to respond to vulnerabilities. So if we have OS systems, and we have some Windows 2008, now that may not mean much to some of you, but that's a very antiquated operating system. We still have platforms that need to be remediated. Some of the vendor patches to be able to defend against vulnerabilities and threats cannot be done effectively on those platforms without upgrading those. So I'm trying to give examples of which make up that $24.3 million of why we feel up to 31% of that investment needs to be made this year. And it's to help us not only stay current and ahead of being able to be reactive and exposing NIPA to greater risks. Does that help, Tracy?
Yes, thank you very much, Rob. Any other questions from the committee?
Yeah, just
My question.
Madam Chairman, Chairwoman, I just wanted to comment that in a lot of the expenditures that we're making now are, as Rob said, are to upgrade patches and to upgrade the end-of-life systems that we have in our enterprise. If you recall back to May of 2017, there was a WannaCry attack that was a global attack, and it specifically targeted outdated operating systems. And so it is absolutely essential that we maintain the patches and we update the end-of-life programs. So I fully support this application.
Thank you.
I've got two questions, Tracy, Rob. One, should we be doing more than what you're asking? Help me with how stringent you've been in evaluating what we need versus what we want. Given the current circumstance, given the incremental exposures, given the increased reliance, should we be accelerating our timeline here, or are you confident the 24.3 million will be sufficiently responsive to what's needed?
So, great question. And I feel very confident with the analysis due diligence we've looked at of what work needs to happen and the interdependencies between the ecosystem that we currently have. And it's really around technology change management. There's some things that you have to do as prerequisites to other work. So as we look at the full body of work across these four initiatives, or programs as it's also referred to, there's certain things that need to be in place. So as an example, you all approved a $34 million capital expenditure last year for enterprise storage, as you may recall. We deployed that in earnest last year. We are still moving some of our workloads to those platforms. That was foundational for us to handle the volumes of data in a more secure manner. And I used the term of segmentation during that time as well, where we can compartmentalize the information. That was a prerequisite to some of the work that we're doing today. So, John, to answer your question directly and through examples, there's a certain order. I don't want to say it's sequential, because we are trying to fast track wherever we can, but not to create complications or rework or potential exposures by trying to rush into it.
Got it. Which leads into my second question. Help us with just the capacity, internal and external, to execute on this. Rob, is most of this on us to deliver and install or perform, or are we dependent on external service providers that will be compromised in some way, shape, or form? What are your concerns, if any, relative to just the capacity that we have, or those that we're counting on will have to perform?
It's a great question. And whether it's under this situation that we're faced today, or I would argue any time, had we not been faced with the virus situation, we always have to look at our dependencies on third party to be able to help implement. Given that we have standardized through our architecture design, equipment that's fairly standardized, we're not beholden to any specific vendor. So it gives us more options in terms of not being tied to one particular vendor. We have a plethora, we have more because it's universal in terms of technology set. In terms of the balance between external labor and internal labor, we feel this is very doable, even in today's market. Obviously, we have to time things, but some of the upgrades that we have, they're well known. They're not something we have to discover, and that will put us at risk. We can execute with certainty, so long as we can get the availability of the infrastructure with least impact to our business and our business operation. So in terms of some of the other programs, there's a balance, as you probably read in the memos, where we have internal labor. In the data management space, we're using more internal labor because we need to, because we have the intelligence, and we're building and retaining that intelligence in terms of knowledge management, knowledge capture, so we don't execute the work only to farm it out. We need to retain that knowledge as well. So there's a balance between implementing knowledge capture, knowledge management, using the third party in terms of the commodity services, because they can do things more efficiently than we can, and making sure that we have contracts in place with qualified providers. Will we have some challenges that we didn't see before? Very likely. But I feel that with the expansion of the sourcing pools that we worked with within our internal sourcing management group, that we're in a pretty solid position to be able to get this work done.
Is there possible, since the construction installation is typically a significant multiple of the internal labor, if push came to shove, could you do more internally, or are you dependent on third-party providers to install and construct, or is that something we can step into? I'm not trying to save money, I'm trying to ensure execution. So do we have capacity to do that, or no?
We do. It will come down to, and just as we're doing today, is prioritizing our resources. And I'm talking about specifically internal labor. Right now, we're focusing on what we can do, given some of the slowdown in availability and third parties. So specific to this type of work, yes, we can redirect, because we do have qualified subject matter experts that are in many cases certified to do this work. I will not subject people to go do the work if they're not certified. To me, that's introducing more risk into the infrastructure. But I do feel we have enough core that we have today that we can still progress this work if the third party was not as available. Now, that may be at a slower pace, granted, simply because you do less parallel processing, if you will, and redirection of the resources. But I believe that we can stay ahead of the curve in terms of the risks and the need to stay current for us to make sure that we're protecting the assets as the threats and vulnerabilities also increase at the same time. That's today's position. And we are constantly looking at the allocation of our resources and how we focus at BAU versus, let's say, projects. Fortunately, many of our resources, by design and by necessity, are focused on running our basic operation, or what we call BAU.
And so given that we're at the end of March, this is a 9-month project, or these are 9-month projects?
They are, and if there may be, due to scheduling availability, it could bleed over into next year, but our goal is to get this done because of the time pressure.
Yeah, okay. All right, thanks.
You're very welcome.
Yeah, I'm just want to ensure we're able to execute and accept and embrace the priority and sense of urgency and importance.
Understood.
Mr. Chairman, Rob, as we transition to a work from home strategy and a digital workplace, how does that increase the attack surface, and what is our ability to visualize the threats across the entire enterprise?
So the work from home, I mean, let's face it, it's great to be present, right, in the workplace. But fortunately, our tools, how we monitor, how we filter, and look at the threats, call it from a cyber perspective, I would look beyond that and looking at how data is being accessed through our custodianship of data and the data ownership. We have very good visibility. The investments we want to make and the ask as part of this capital expenditure request gives us even greater visibility. And it's a great question because part of what we're trying to implement in 2020 through this request is to expand the visibility, which we have good visibility today, is to be able to look at any device activity and be able to control, monitor that activity from that point. Do we have that today? No. We feel we need that to understand how the threats are coming in and essentially moving around. So that's just one of many examples, but the tool sets themselves will help us to filter through some of the threats, vulnerabilities, to help us prioritize to address what we need to first and foremost. Michael, did that help?
I'm happy to move approval of the 4 resolutions as presented. Tracy?
Great, thanks. With that motion, can I get a second?
Second.
All in favor, say aye.
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 Any opposed? Great, motion carried. Thank you so much, Rob.
Thank you all.
Thank
And
you.
stay safe.
Thank you. You too. I'd like to now invite Adam Barsky, EVP and Chief Financial Officer, and Christina Reynolds, Treasurer, to present the next 5 items on our agenda, which will outline and discuss the financial operations status for NIPA and the Canal. Adam?
Good morning, Tracy and members of the committee. The first item is just an annual update of our investment guidelines for the OPEB Trust. And we've made just a few updates that I'll cover briefly. One was just to prohibit direct investments in fossil fuel and to utilize the principles of environmental, social governance factors in the investment process and other best practices, including the hiring of a proxy agent to handle proxy votes on behalf of the trust and the beneficiaries. The time horizon has been extended to 30 years from 20 years, and the economic cycle has shifted to 5 to 7 years from 3 to 5. The other addition that we're going to discuss is some of the other changes our outside financial advisor and staff are recommending. And one is to maintain our 7% targeted rate of return on the funds. So the funds are approximately $600 million today, which is, and actually higher than that in terms of after the 20% gain in 2019. And it's actually more than 100% of the liability that it is looking to fund, which is the OPEB liability. And just for people's background clarification, OPEB is other post-employment benefits. So our employees, when they retire, if they depending on the date of their hire, they've met certain eligibility thresholds, they've worked with the authority for 10 years or 15 years in some cases, they are considered vested and eligible to receive post-employment benefits. Those include health care, insurance, and then if they reach the age of 65 for Medicare, they get Plan Part B benefits as well as life insurance benefit, and they get to also have the option of cashing out sick days and unused vacation days as all of their sort of post-employment benefits. The actuaries do an actuarial calculation based on the GASB standards, and that liability today will show how that's changed over time, but it's around $600 million as of today. The assets of the fund are generally broken out into equities, 61%, fixed income 30%, and then 6% for REITs, 3% for cash. When looking at where we were over time and based on our targeted intervals, we were beyond some of our targets for the equities because it had run beyond the targeted range, and we will need to rebalance. Given the market changes that we are experiencing today, that need to rebalance has probably been delayed. But the idea was to allow the trust to be able to invest in other asset classes that are less susceptible to overall market indices so that they have a lower correlation to, say, global equity markets or fixed income markets. And those would include certain targets of asset classes such as infrastructure, private real estate, private equity, private debt. And we've sent some information out to the trustees that compares our asset allocation to the asset allocation of the New York State Pension Fund, which we are also all part of, to show sort of where they are versus where we are. They have a 10% allocation to private equity. We're looking for, say, a 7%. The chart that I'm showing here just gives you some historical perspective as to how the liability, once we established the trust in 2007, you can see in the blue line that the accrued actuarial liability started above 300 million and has steadily grown over time to where it's right around 600 million today. The authority has made significant contributions in the past to the trust, and then as the trust was earning based on its rate of return, those contributions ended up being lower contributions from the authority because the investment returns were meeting the 7% actuarial level. But where we stand today is that we are over 100% funded, which is really a good news and good story for us because we have more than sufficient assets to meet that liability. The rating agencies consider this to be a credit positive. This chart just shows you some of the returns over the years since the trust was established and shows what the NYPA contributions were and the funded ratio. And you can see for the last 4 years that we've been over 100% funded. So the recommendation we're looking for the trustees is to recommend to the board to approve the OPEB Trust Investment Policy Statement, which is included in the materials. And the other thing just to raise, because we had some questions from some of the trustees, also in the investment policy, we've created a more formalized governance structure, which will include a variety of treasury, accounting, human resources, risk management, oversight of the trust on a regular basis. Currently now the trustees do receive a quarterly report as to the performance of the trust, as well as the annual update to the policy that we're sending you now, as well as the annual report. And that's all in the materials that have been sent to the trustees. Are there any questions?
Yeah, Adam, just a couple of questions that I had. So if I look at this in two chunks, first on the policy statement, which I think is consistent with how we've approached our efforts to support the governor's drive to increase renewable energy throughout the state and reduce reliance on fossil fuels. This policy statement, it is a formal statement that you have prepared and that you then send out to all of the managers. How are we enforcing this? Is this done by voting, or, do you then withdraw funding from managers who aren't committed to this stance? It wasn't clear to me, and it helped.
Right. Okay. So
what it means.
That's a good question. So really, the answer to that is this statement will go out to all of our managers, and most of our investments are in SMA, separately managed accounts. So they will be instructed that if they have any fossil fuel investments, they're to divest of those, and make it up with other acceptable alternatives. The only area where, as of right now, we're not requiring that to be done is where we have passive index funds, and those are a little bit harder to manage, but we will be looking for because it is becoming a growing topic today in the pension and OPEB trust field, to have index funds that are fossil fuel or other type of initiatives like that people are looking for, or ESG focused. So we will look for those as they become available, but right now it's just that a direction to our managers that none of them can make a direct investment into these type of companies.
Great. And then my second question is around the change around our portfolio mix. So you gave us some quick statistics around, where we are now in equities and whether it's bonds or treasuries. Can you just help me understand and you now want to change that portfolio to look more weigh a little bit more heavily in fixed income, or let me explain, correct me if I'm wrong. Can you give me a little bit more about what are the assumptions that you're making for why you want to change the portfolio mix of where we had been previously? Again, dividing up, heavily toward private equity, private debt, infrastructure, real estate.
Right.
Can you help me understand that a little better?
So the idea is just to make and again, this will be executed over a longer period of time. We thought we had an immediate need because, again, equities had outperformed and outrun all the other asset allocations, and it was beyond our range, and we were going to need to rebalance. And we would have been left with rebalancing into lower, sort of lower rated, lower rate of return type of investments. So this was an attempt to allow us to have more diversification in the portfolio, sort of de-risk it, if you will, in terms of its susceptibility to the greater market indices, and have some of these type of investments that aren't as susceptible to moves in the market as the rest of the portfolio. So the idea is still to be, it's still in this 60-30 type of mix, but the 60 is going to be, just not in equities and international equities and an emerging market. There'll be some allocation, like I said, up to 7% for private equity, and same in the fixed income area. There'll be a small allocation to, say, private debt, and then also including things like an infrastructure fund, again, long-term investments. And the idea was to have greater diversification in the portfolio, and more asset classes that are not as correlated to each other. Given when you have a market meltdown as we're seeing now, it more or less proved the point. So had we worked with our advisor in in-house risk management, did analysis, and again, given what's happened in the market today, had we had some of these allocations already in place, we would have been a little bit better positioned to withstand the market downturn that we're experiencing right now. So it speaks to the idea of just more diversification in the portfolio to maintain our long-term target of a 7% return. And as you can see, the returns here, there is a lot of sort of volatility in the returns. They've gone down as much as 34% during the financial crisis. They've been up over 20% in certain years, and 2013 and 2019 was a good year as well. But the idea just to be more diversified.
Great. And I think we talked about it a little bit, if you could, going forward for us, for the committee to be able to capture this in a way that's more absorbable, like a division on a pie chart of where we were in terms of the divide between equity, real estate, infrastructure, and where you're planning on going for the team, and what that division is, would be helpful, I think, for everyone to be able to see in a firm picture of what that is. Great.
Right. So we'll give you pie charts and graphical information that will show how it's doing, how we benchmark ourselves against others, and how the various managers in our asset classes are performing against their relative benchmarks as well.
Great. I just think that'll help the committee. Any other questions? No? Okay.
Okay, so the next item on the agenda is 4B,
Do we need to vote there?
No, I think we're going to take them all just as we did the IT and cyber spend. We'll take them all together.
These are all fruit cocktail. I mean, IT was one. These are totally unreal. Well, whatever. Okay.
Okay, so the next item on the agenda is seeking the authorization to be able to issue series of 2020 revenue bonds and the plan of finance. We've had some opportunities in the marketplace. Obviously, the current dislocation has sort of changed that opportunity as we speak now, but we are still going to move ahead to be positioned to execute on our long-term financing plan. And the idea was that we would be able to refinance between $240 million of bonds that can be called and refinanced that had been previously issued in 2007 and 2011, as well as issuing up to $600 million for both new money and for replenishing our cash reserves. The bonds would be issued as senior lien revenue bonds and potentially would get a green bond designation. They'd be a mix between tax exempt and taxable under the authority's general resolution authorizing revenue bonds. Additionally, we're also asking for an increase in the authorization for our revolving line of credit from $700 to $950 million. This would allow for an additional $250 million of a revolver line of credit from the bank group that we currently have in place that would allow us to finance any short-term cash needs as they arise and be available to us, and some mixture of the two. In addition, that would also allow us the authorization that as an alternative to issuing bonds to be able to do a term loan facility with banks as an alternative if it turned to be more attractive and accessible than what the long-term capital markets are presenting to us as an opportunity. Just to give people a sense of where interest rates have gone, both in the taxable and the tax-exempt market, looking back to 1990, you can see that we are at very low historical rates. Certainly, as you look at the Treasuries and the MMD curve for the tax exempts, that is going to continue to be in place, we think, for the foreseeable future, certainly in the Treasury markets. But as we've discussed over the last few weeks, that there has been some dislocation in the markets as we speak. So right now, it's something that we are watching on a daily basis. But again, we will be moving ahead to put all the pieces in place so that we can execute when the opportunity is right and have alternatives to that, to our financing should the markets not be as opportunistic as we would like. Just as a sense of reference, the last time we issued bonds was in 2015, and that was only for 10 years, and the rate on that was 5%. When we ran this report on 3/19, the world has changed a lot since then, but the rate at that point was 4.38% lower than, and for a 30-year maturity, much lower than we had issued in the past, just to give people a historical sense of where we are in the rate curve. Is there any questions on that?
Yeah, just Adam, that I had, because I want to make sure that I understand what we're providing you sort of authority on, because it seems to me there are three different parts of this, both the bond issuance, as well as sort of an expansion of or creation of a revolver, and the third being the option to, and I want to, those are three different facilities or three different approaches to our financing, and I want to make sure I understand. On the bond, the total that you are seeking the ability to go out and pursue is what amount. Under the revolver, you want an expansion of what amount, and then a term loan. Again, you were going to, sort of, this is all work for you to be doing, but what today of the amount of a term loan that you may potentially be able to see? Do I have those three different categories?
Sure.
Right?
So they're not mutually exclusive. In other words, we're not adding all those up. So we're saying is we have authorization, we're seeking authorization for $950 million of tax-exempt, taxable bonds that would be issued in the marketplace, varying maturities up to as far out as 30 years. The authorization for that 950 would also allow, as an alternative, if it was viewed to be advantageous to the authority, that instead of doing a bond issue that would be sold in the capital markets, that the alternative would be that same 950 could be structured as in a term loan facility as an alternative. So it's which either one we believe would be the most advantageous to the authority. We would obviously come back to the board and report to them as to how that was ultimately executed. So that's the 950 for the long-term financing request. The other is to expand our existing authority to issue up to $700 million or half of $700 million of a revolving credit facility, which is currently in place, and it supports our commercial paper program, to allow that to go up to 950, and that additional cap would either allow us to just have a pure revolver that we would use with the bank for cash needs, or it could also support further commercial paper issuance, again, for corporate purposes if we deem that to be advantageous. So the idea is to be nimble, have the flexibility and the optionality to execute on our financing plan in the way that we believe is most advantageous for the authority.
And what's the basis for concluding 950 is the right number, Adam? Why do you think you need the increase to 950 versus some other number? I mean, help us understand how you're forecasting our needs.
Right. So originally, when we were putting this together, it was done with the mindset of what did we need to refinance existing debt. So that's in that 250, 300 area. And then the other 600 million would be broken up in two pieces. One would be cash to reimburse the authority for cash it's been laying out over the last few years, because all of our capital projects have been cash funded. And our original plan of finance, or our sort of principle going forward, is to really do a 50-50 mix of cash and bonds. That just hasn't been done over the last few years for a variety of reasons, but it's been 100% funded. So we wanted to replenish our cash position to get back to cash flow and cash position metrics that we believe are ideal for our authority to maintain our credit rating. The other 300 million was to handle new money issues for our existing capital plan for the projects that we have. To the extent that we're not going to use that for new money to fund our existing capital plan, we would have the ability of utilizing that 300 million as an additional cash buffer to either be used to actually fund out capital projects as we needed them, or to have in our cash reserves to be used for whatever purposes we feel is consistent with the authority's budget, financial obligations that need to be met, and so on. So in other words, it's just to be able to get our cash position back to a level in which we believe is most prudent at this given time.
But at this given time, was it at this given time 2-3 weeks ago, or is that today?
It was 2 weeks ago, but it's also today. So one of the things, the metrics that we look at is our, in addition to our cash flow forecast and our stress scenarios that we're currently running, we maintain a target of days cash on hand. And at the end of last year, it was 150 days. As we speak today, it's down to about 130 days. Our goal, our target for a long-term basis was to maintain at least 200 or more days cash on hand. So this issuance would have been able to achieve that target goal in terms of our forecasted cash position.
Well, we can only assume the assumptions today would be different than they were at year end, or even as little as 2 weeks ago. So I just want to ensure we have enough flexibility to do what's needed in what's obviously going to be a very unpredictable an extended period of time. So not to minimize 950 million, but I do want to ensure that we're able to pursue and be nimble and accomplish whatever is needed. So I would ask that you refresh that analysis to ensure we have all the tools in our toolbox that we need under what are now much more adverse and onerous circumstances. So
I
if we
agree
can
with
get
that.
a refreshed analysis, even between now and the board meeting next week, that would further affirm that 950 is a sufficient number to whether it's hit our internal metrics or otherwise, meet our needs under some more onerous worst case scenarios.
Agreed, and we will be providing that analysis to you and the other trustees before the board meeting next week.
Great. And Adam, if you could also add on to that, because if I recall correctly, that while it's not a firm line, there's an imaginary line in terms of rating it, staying under there's some, sort of psychological reasons about staying under the $1 billion. And so any impact that might have or consideration that, being above that amount would have for rating agencies would also be helpful for us to appreciate, as it may have gone into some of your thinking around why that amount as opposed to, $1 billion or over $1 billion, that somehow when you get closer to that line, there are different or increased considerations that rating agencies and others might have.
Yes, we'll do that. And again, as part of this process, regardless, we will be going to the rating agencies, presenting them with our 2019 financial statements, our plan of finance, and our projection as to how we would maintain the various metrics that they're looking for. And obviously, they will be asking questions about the current environment and looking for evidence that we have the necessary tools to access financing, but also balance sheet position to withstand a variety of stress scenarios. So they'll actually want to be having a dialogue around that so they can understand it. So this is something that's going to be an ongoing discussion over the next several weeks. Right now, we're planning to meet with the rating agencies in the first week of April.
Great. Any other questions on that? Adam, thanks.
The next item is as we're going through this process, we had a 5-year previous contract of underwriters and banks that we would do business with for general corporate purposes. That authorization had expired towards the middle of last year, towards the third quarter of last year. So we had to go back out and have an RFP and select a new group of managers. And we had over 29 firms submit, and we looked at a number of criteria that the various firms would have in terms of experience in this industry with public finance, issuing green bonds, tax-exempt, taxable, diversity issues in terms of MWBE and service disabled veteran business enterprises, and each of their compliance with various diversity commitments, their financial strength, their position in the public finance markets, their CRA rating, and sort of ideas and value added they would be giving to the authority in terms of things that we should be looking at potentially differently. Of the 29, 21 were selected. We break them out on this chart into really 3 buckets. There are senior managers, co-managers, and selling group. We do have the flexibility that if one of the co-managers, let's say, comes up with a great idea that nobody else has brought to us, they can certainly get promoted and elevated. But the list of the senior managers are listed of Bank of America, Citigroup, Goldman Sachs, Ramirez and Company, Siebert, Williams, Schenck. Of that group, 40% of that group is MWBE, And of the remaining group of the co-managers and selling group, the other 16 firms, 69% of those are either MWBE and/or service disabled veteran organizations. Are there any questions on that list or the process? We think this is a good a mix of firms that will help us market and distribute our bonds in an efficient way when we are going to the market. So we're very pleased that we had this sort of interest in representing the authority. Okay, if there are no other questions, it's just what I spoke about. So the next item is just an update. We're going to go through this in more detail at the audit committee, but just for the finance committee, just to let you know that the audit is completed. Again, we'll be giving more of an update to the audit committee, but just wanted to give this committee a briefing that where we ended the year. If you recall, we had projected in our last meeting where we thought we would end the year, which was around $23 million versus our budget of 21. That's where we ended. So there wasn't a lot of deviation from our last projection and where we ended. The audit ended with KPMG without, any material items being raised, either as material weaknesses, significant deficiencies, or any other items worth noting. In terms of the balance, again, this is just how the revenues ended up and where our net position was. Our net position increased by $26 million, which was a combination of the $23 million net income, and then there was a $30 million contribution to NIPE as a result of a wind farm project, which added to our assets. So that combination of that was the $26 million in increase in our net position. In terms of our balance sheet, there's, the difference in cash, as I mentioned, is really just the pay down that was used on a net basis versus what was coming in through operations and what was going out to pay for capital primarily, and is really reflecting in what the major change was in our cash position. Otherwise, our other parts of our balance sheet remain pretty stable. And some explanation in the presentation, just as we had mentioned before, in terms of why there was a miss on the budget in terms of where energy prices were last year and other increases that we had during the year in terms of our pension expense and OPEB expenses. That's pushed up our O&M expense. But other than that, really nothing here changed from the last updates that we had given you. In our notes, very few updates from the notes that we had from last year, except we did make mention of the new legislation affecting the authority, which is the expanded authorities. There's no impact of any new accounting pronouncements that affected the 2019 results. We did have some conversation last time about new GASB pronouncements that are coming out for 20. We'll have more of a discussion about that in the audit committee, but that had to do mostly around the leases and also on fiduciary assets and on how interest during capitalization. Those are the real three main changes in the 2020 GASB standards, and we'll go through the impact of any of that that we may think on the authority. And then there was another update in terms of a lawsuit that had been reported on for a number of years that the authority was successful in litigating and was dismissed without any financial impact to the authority. So that was a very positive result in terms of any contingent liabilities. Again, the only other updates, there was a note to talk about Reimagine and where we are going with the canals, and then the update on the major capital projects. But this is just, sort of just an overview of the financial report that will be provided to the audit committee and to the full board and to the state. Also in this annual update, we do have the annual report on investments and changes to the investment guidelines as it pertains to the authority's cash. And that's just a regular update. The only thing that we have added was just, again, in terms of more diversification and liquidity, the ability to do guaranteed investment contracts, repurchase agreements, CDs offered through, say, a CDARS program where you have a full FDIC insurance on any amounts that you place with banks, concentration limits, 40% for money market funds and no more than $50 million in any fund, and for no longer than 30 days. Expanded the term for the repurchase agreements to 30 days with a value limit of $250 million. And that summarizes the updates on the investment policy that will be filed with the state. Any questions on any of those?
Thanks, Adam. And as you said, this will be discussed in more detail in the audit committee meeting next week.
Yeah,
Great.
just wanted to make sure this, this committee had just a heads up on it as well. And the last item is just the normal release of funds we do for the canals, that to release the second quarter amount of money that would be used for the O&M of the canals. I'm sure you're familiar with seeing this every quarter. We're going to continue that quarterly practice of requesting the release from the trustees as the quarter approaches. Any questions on this item?
I guess one question that I had specifically on the canal item, are we doing the same kind of evaluation for the canal as we're doing for the rest of the organization in terms of focusing on what's essential spend going forward? And I know we'll probably have a longer conversation about the work around sort of reimagining the canal and more strategic evolution of the canal. But are we doing the same kind of evaluation of this spend? We've set this in motion, but we're not, again, this is not business as usual. Are we doing, are we being as disciplined about, our evaluation of the canal as we are the rest of the organization?
Yes, everything throughout the organization is being looked through the same lens. So anything we're talking about in terms of options in the rest of the organization does apply as well to canals, in terms of opportunities for any kind of expense reduction or any kind of pause issues or anything related to that. I don't know if, Gil, you want to elaborate or add to that discussion?
Yeah, so as Adam mentioned, we are looking at everything through the same lens. So whether it's NYPA capital, NYPA O&M, NYPA discretionary expenses, canal capital, canal O&M, canal discretionary expenses, or the reimagine the canal, all of that will be through the same lens. And while things are unclear and visibility is limited to none going forward, that we are hunkering down and making sure that we are only, for now, funding those that are what I would classify as safe and secure, for the reliability and safety of those assets and the people that they serve.
As I hear that, Gil, while the authorization here is for up to $22.8 million, I'd like to think what you've just said would suggest that the anticipated expenditure in light of where we find ourselves today would be something less than the $22.8 million. Is that a fair conclusion?
That's correct. That's correct. Precisely.
And Gil, that means that the Reimagine the Canal authorization at our January meeting is on hold for the time being.
Well, Judge, the authorization is there, but as we said, we were going to go back to you anyway for specific drawdown associated with specific projects. So for now, until things become clearer, we're not coming back to you with specific projects and specific drawdowns of that amount.
Got it.
And hence, I'd come back and while we'll approve this, I'd like to approve it knowing that you'll circle back to us sooner than later with what you anticipate a more relevant number to be. I'd hate to have this framed as just another quarterly request, since we find ourselves in other than just another quarter. So, excuse me, I just want to ensure that you'll come back to us soon with what you deem a more relevant appropriation of funds for the benefit of canals for the foreseeable, fuzzy, cloudy, uncertain future, other than the 22.8 million that's been requested. Is that a fair request of you?
Yes, we will, and we will come back to you with, the what we think will be the safe and secure number within that total amount.
And you should be able to give us some range at least by next week's board meeting?
Yes, absolutely.
Okay, great. Thank you.
Great. Any other questions? So thanks, Adam. Just to be clear, what are the 5 items that we have before us to approve? One is the OPEB trust policy statement changes. The second one is the financing capacity, both the bond and facility planning. Third is the appointment of the pre-qualified underwriters. The fourth is the 2019 financial report update, and the final being the release of funding for the Canal Corporation. Those are the 5 items that are before the committee now for a motion to adopt, to then go forward to the board. If there are no other questions on those 5 items.
So
Second.
Second.
And
Again,
all I ask is that the bond approval funding, as well as the canals appropriation, we're approving with an asterisk, knowing that we're going to get an updated analysis to either support the existing request or some modified number, hopefully between now and next week's board meeting.
Yes.
Yes.
Exactly. For
Okay.
today's, and Adam, I think that those 2 specific items are one where there's some outstanding additional information that will be coming to the full board for their final and ultimate approval of this that the committee is now sending to the full board.
Yep, will do.
Great. So with that, if I could get a second.
Mike seconded it earlier, Tracy.
second.
All right, great. First,
Is it all in
Give me
favor?
a-
Aye.
Aye.
great. If not opposed, the motion carries. Thank you, Adam.
Thank you.
All had the consent agenda and been able to review it. It consists of just the minutes from the last 2 finance committee meetings. It's now for the full committee for adoption. If I could get a quick motion to approve the
So
consent agenda.
moved.
I can get a
So
second.
moved.
All in favor? Say aye.
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 Great, motion carried. The next joint finance committee meeting is scheduled for May 14th. And if I could ask for a motion to close this meeting.
So moved.
Second.
Second.
All in favor, say aye.
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 Great. This motion carried. Adjourned. Thank you, everyone.